It was the worst week for stocks since January of this year. It was the worst single day sell-off back on Tuesday in over 2 years. The S&P 500, it was down 4.8% on the week. The NASDAQ was down 5.8% on the week, and the Russell 2000 lagged both of them, only down 4.5%. It's time for another stock market crash update. We're going to go through the S&P 500, we're going to go through the NASDAQ 100, and we're going through the Russell 2000. We're going to look at them from various time frames, and we're going to really get a handle on how far can this market go. Where are we looking at as a potential bottom or potential bounce areas? We're going to get to all of that and more in this video. But first, make sure that you like and subscribe to this channel. It helps me out tremendously, and I appreciate every one of you guys being subscribers. One of the most common themes that I've seen in the stock market this year and during this huge sell-off has been the idea of everything's priced in. The sell-off is priced in. The rate increases are priced in. Quantitative tapering, that's priced in. And then we start looking at things like Jackson Hole. We're like, oh yeah, we're going to rally. Market's rallying because it knows that the Fed's about to pivot. Did the market have that priced in? No, didn't even happen. But we always talk about these things are being priced in. How do you actually know if something's being priced in? Market rallied ahead of the CPI report. Technically pricing in that. Did that happen? No, that was a horrendous CPI report. Or what about the Fed interest rate cuts in the beginning of 2023? That was supposedly getting priced in back in July and August. Well, that was some pretty poor pricing in right there because that didn't happen either. And so we're doing all this pricing in for things that don't even actually happen. And then we're already saying things are priced in already for the bad things that are happening. Who are we getting this from? How does anybody actually know what's priced in? You don't know what's priced in. Nobody does. It's just guessing. They're not trading what's in front of them. They're not trading the charts that are and what they're telling you. They're just hoping, because most of the pundits that you're seeing on TV, they have no clue what they're talking about. Most of them have probably never even seen a bear market or even worked through a bear market. And when they're getting in front of the cameras and telling you, oh yeah, this market's ready to take off. Oh, we're going back to 4,800 by the end of the year. And yes, there's analysts out there that are saying that. Why are they doing it? They're talking up their book. They're doing it because they need the market to go up there. And what I'm trying to tell you here is we don't have the luxury of trading the charts that we want. We have to trade the charts that are in front of us, the charts that we have. What is the chart telling you? Not what you want it to tell you, but what it is telling you. And that's what so many people are forgetting to do in this market. And we're still seeing dip buying, crazy amounts of dip buying on the retail side. Why? Because they need the market to go back up. They can't afford to take the loss. So what do? They just keep doubling down or tripling down or just keep adding to their positions that are continuing to lose for them. That doesn't end well. And maybe you're watching this video and you're saying to yourself, man, Ryan, I do that too. Well, why are you doing that? Because you're afraid to take the loss? Because you're being undisciplined? And so that you're hoping that being more undisciplined, that the market's going to forgive you and just let your positions go right back to break even, which if it did, and you'll probably make a promise to the market saying, hey, I'll go ahead and get out of this trade if it goes back to the break even, and you won't. You'll think, well, maybe it's going back up to all-time highs. Now I'm going to keep holding on to this position, and then you find yourself in the same position as before, just continuing to lose money. So don't fool yourself into thinking that, oh, if we can just get a big market rally here, I'll be okay. Market doesn't care about what you need or what you want. Trade the charts. Trade what's in front of you. Trade what the charts are telling you, not what you want it to tell you. There's a lot of traders out there just making horrible decisions. I'm seeing it at the end of the day with these crazy rips to the upside, only for them to lose their money and even more the following trading session. With that being said, let's go ahead and get to the charts here. First off, we're going to look at SPY. What do we have on SPY? First off, still the declining trend line. Man, this declining trend line is so very important for this market going forward. If it doesn't break that, we don't have a new bullish market. 2 different times it has sold off hard, and you also had the 200-day moving average, which is actually this white line right here working perfectly alongside of it, dropping at the same slope as this declining trend line. So there's multiple layers of resistance there with the 200-day moving average and this declining trend line that goes back to January of this year. Now check out this rising trend line. What happened here? Thursday, we broke below it. This is a trend line that has held very well for the market over the past 3 months, going back to June. We tested it in July, we tested it in September, and now here on the 15th of September, we broke it and we followed through with a gap lower the following day. And you look down here, you can see there's volume pouring into this market now, which indicates an increased amount of selling. So any kind of bounce attempt that we see here, you're going to want to watch this broken trend line here and whether it can get back above it. If it can't get back above it, that's a clear sign that the market's ready to take the next leg lower. Where do I ultimately see this thing going? First off, you got a little bit of support here at this 372, 373 level. Not sure it's going to hold. It's very tepid at best. I think if you get a test of it and it bounces, that's great. I'm just not sure that level wants to hold for you. if that level breaks, then you're going right back down to this retest of the June lows from this year. That's going to be a critical moment for the market. Does it double bottom at that point and start to rally back up again? Or does it crush that level and keep pushing lower? Now, look at the weekly chart for me here. What do you see here? Almost like a bear flag pattern that has developed going back to May. This bear flag pattern confirmed to the downside. And so once again, this support level here is going to be key, 373. If that level breaks, then again, we're going to the June lows. But one thing you can see consistently on this chart, and it's very well put together, is lower lows and lower highs. Another lower low and another lower high. So it makes sense here that we make another lower low here. And there's not a lot of support for this market. On this weekly chart here, yes, there may be some that can kick in around this 346 level, but I'm not quite sure it's very strong. It's essentially connecting some previous tops and some previous bottoms to form this support level. But even more importantly, and let's get rid of this support level, is this 200-week moving average. This 200-week moving average has been very strong for this market for many years here. This goes all the way back to 2011. Now check this out. We bounced there. We bounced once again in 2016. Once again, bounced off of the 200-week moving average in 2018 when we saw that significant sell-off as a result of quantitative tapering in Q4. Then you had the COVID sell-off. It did break through it, but it quickly reclaimed it within a matter of weeks. Now, I ultimately expect us to get a retest of this 200-week moving average, but in true recessions of what we've seen back in the past from 2000 to 2008 and even the one in 2020 is that it eventually breaks it. And that's the mark of a real recession according to the stock market. So going back to 2008, massive break of the 200-week moving average. And it took a very long time. It took a couple of years for it to reclaim that 200-week moving average. Going back to 2000, same thing again. We broke it in 2000, reclaimed it in 2001, and then sold off. It never reclaimed it again until late 2003. So this is a significant area of support. If it's not going to be a major stock market correction, we probably don't break this 200-week moving average again, the white line here on the chart. If it is a major stock market correction like what we've seen in the past, we will break it. We did break it in 2020, like I've already mentioned, but because the Fed stepped in and created such enormous amounts of stimulus for the economy and such favorable monetary policy, it allowed for the market to quickly recover. But this time around, the Fed's already said, hey, we're not doing that. So you have to take them at their word as long as they're willing to stick to their guns. And so far, they are. Now look at the SPY monthly. Same thing, very similar moving averages between the 50-month moving average and the 200-week moving average. And you can see the same kinds of results where it's bounced off of it each and every time. So that's why I still think that we're going to probably test this particular area on the charts, especially for SPY. Again, we tested it again here, and I tested it again back in 2011. Now let's look at the Qs, and we'll look at the weekly chart here. Again, 200-week moving average gets just above it and then bounces. See what I'm talking about here? 2018, same thing. Saw it in 2020, saw it again here in 2022, and then we bounce pretty significantly. So it makes sense that we're going to retest it. Now, if it's anything like 2008, which I suspect that it is, again, another bounce right here in 2015, then yes, we will break the 200-week moving average, just like we saw in 2008, and again, in a very significant way in 2001, which never saw it actually recapture it again until 2004, right here. On the daily, what are we looking at here? First off, you have a head and shoulders pattern. You got the left shoulder, you got the head, and then you got the right shoulder. Has it confirmed? It most certainly has. Look at this break right here, right across the neckline, and we got the follow through on Friday. This chart, more than any of the other index charts out there, suggests that we're going to see a retest of these June lows right there. Now, how about IWM? IWM is probably holding up better than any of the other indices. Why do I say that? Because this rising trend line here has yet to be broken. We're sitting right on top of it. Plus, there's an additional support level that it's managing to hold on to right here. So two support levels right near each other, both holding up the IWM chart at this moment. That doesn't mean it can't break to the downside. In fact, it does have an inverse cup and handle pattern working. It's basically a saucer that's upside down. You got the cup part here, again, upside down, and then you got the handle part right here, once again, upside down as well. So cup and handle pattern, that one would confirm on a break of this major support level right here at about 177. If it breaks that, then you're looking at another retest of the June lows. Now on the weekly chart looks far more bearish for IWM than any other because you have this massive topping pattern that goes back to the beginning of 2021. This topping pattern confirmed. It tried to recapture it earlier this year, failed to do so, and saw a significant push lower, and then it bounced once again. Now, we're also testing this 200-week moving average. This one has not held up as well over the years, particularly in 2020, where we saw the massive break below the 200-week moving average. But in the days ahead, we're going to want to pay close attention to this. But again, looking at the daily chart, if the rising trend line off of the June lows breaks, and then this key price level support breaks, then you're looking at a retest of the June lows. In the end, we got to be on guard. Like I said in the beginning of this video, trade the charts that you have in front of you, not the charts that you want. So many times we are overly optimistic about what we expect out of a chart. Instead, we just have to be more pragmatic and just look at what the chart says before us. Right now, it's still a very bearish picture. You might think that I'm overly bearish on this market, and I have been for pretty much all of this year. But that's also because that's what the charts have been telling me. Have I done everything perfect? No, definitely not. But I have been profitable throughout the year, which most of the people in the stock market can't say for themselves. And the reason why I've been able to do that is because I'm following what the charts are showing right there in front of my face. Again, I'm not going to get it all right, but even if I can get it right 50 or 60% of the time, it'll wind up being a very good year for me. And if you enjoyed this video, make sure to like and subscribe. Make sure to click the join button down below so you can get all my stock market research each and every day. That's going to include multiple videos sent directly to you each trading session. Plus, watch lists, trade ideas, and all sorts of really good things. So check that out down below. Like, subscribe, thank you, and God bless.